It is interesting, this conversation, right, that we continue to have, like public versus private markets. Make the case, because we were talking to Lynn about this, Lynn Martin, about how a lot of money out there enabling companies to stay private longer kind of makes those companies stronger by the time they hit the public markets. But take it away from your perspective.
Well, I think Lynn and I both agree, and we did on the panel, that it's actually more useful from an investor's perspective to assess a public-private continuum as opposed to kind of looking at it as a public versus private markets. And I think she makes this very excellent point that strong public markets are better with robust private markets, and vice versa. But really, from an investor's perspective, the moment that we're in right now is investors are seeking, and actually now have better technology tools and capabilities to evaluate the underlying risk and risk metrics of their portfolios and not be as kind of asset class siloed and wrapper siloed as this kind of public versus private, paradigm sets out. And so I think the moment that we're in markets is figuring out what are the best ways, the risk managed appropriate ways to allow more investors to tap into the economic growth that's being financed privately versus through public listings.
I feel like you would say it would be ETFs.
Actually, it's a really interesting question. ETFs, and Lynn said this, and I was so happy that Lynn said this on the panel, and it came from her and not from me.
Okay.
So I will
what did she
quote
say?
Lynn on the panel.
Because we were over here, we couldn't watch.
Yeah. She said that ETFs have been the single most important innovation in financial markets in the past 25 years. And what she means by that, and I agree, but what she means by that is ETFs have enabled investors to use public market rails to participate in lots of underlying asset classes. So, of course, like more stratified equity exposures, but also, Lynn and I are both kind of deep down, or maybe not so deep down, like bond market nerds. So we love the story of the modernization effect that ETFs have had on the bond market. And of course, we see the ETF wrapper being used for active strategies, for commodities, and for crypto. But I think this question as to whether the ETFs are the kind of magic bullet for private markets is one that really remains unresolved right now.
Why?
Because private markets are because of the kind of questions around what the most useful wrapper is based on what the underlying market characteristics are. So, of course, like when we build an ETF, and I think this is probably true for most issuers, number one, you evaluate the investment thesis, and we all agree there's an investment thesis with private markets. Number two, you figure out like what are the, what's the appropriate wrapper, what are the wrapper considerations, and number three, what are the underlying market structure requirements to support delivery in that wrapper. And an ETF, especially a daily liquidity ETF, needs to be able to support, creation, redemption at scale on a daily basis.
What would be the alternative to an ETF to wrap private assets?
I think that there are other types of mutual fund structures, new types of product innovation.
She said mutual fund, Carol.
Hey, listen, I started my career in business news.
I thought all the mutual funds were going to become ETFs.
Doing a mutual fund show, which wasn't so long ago. It kind of blows my mind to see how things have moved along.
Well, the idea of coming up with a wrapper that lets lots of smaller investors participate in an asset class, that's not a novel idea.
Correct, yeah.
But the question as to whether it should be an ETF, a daily liquidity type wrapper, I think is a really important type question. And of course, private assets are not a monolith. Mm-hmm. So I see what you see happening right now is slowly parts of the market. And what's very interesting is to kind of look at that gray area of the market where there is more transparency. There's some data standards. There's secondary liquidity being provided. Where maybe there's more opportunity to provide ETFs. But I think ultimately where more investors are coming out right now is they prefer to see private markets as a allocation to a broader diversified portfolio, like part of a target date fund. Now, of course, there are target date fund ETFs. Mm-hmm. But I think this question as to whether there will be a huge demand for, private credit ETFs as a building block in a portfolio is really the unresolved one. Where does Carol come out on this? Now I need to know.
I don't know. I don't want to speak for you, but I think like you said, these are not, these instruments are not monolith. It's not a monolith. So, and we spent a good portion of our program today talking about the different areas of private assets that, where some investors are and some asset managers are seeing strength versus where some are seeing a little bit of concern. So, we talk about this stuff being in retirement accounts, for example, potentially, and we look at them. I think a lot of people look at them as monolithic, and the scary thing for some people perhaps is, well, maybe it's not such a transparent asset class because you don't necessarily know what is under the hood.
Yeah, I guess what I would say is I don't think that, defaults are part of a credit investing cycle, and there are plenty of high yield, highly functioning public bond market ETFs that work well. They go down, but they function well in the ETF market. So I think the real question as to whether something gets delivered in an ETF is there secondary liquidity such that it can trade in an orderly way when there are kind of outsized redemptions? And that's not really a question of up or down. It's a question of, is the market structure supportive of daily liquidity and the sort of transparency that is needed to ensure that?
And I do think with private markets, if you're going to reach a broader audience, especially retail audience, I think that liquidity aspect is going to be really, really important for them, and to have that. What can't go in an ETF? I am curious the conversations that you guys have around that, or can everything almost?
Well, I think there's two different questions here. What can't go in an ETF, and what, we might not, put in an ETF that, met, what we want the iShares investor to experience. And that's a pretty important question right now. If you look, and it's actually a really important question in 26.